Assalamualaikum, my name is Hamdany. I will start with the introductions, which is I will talk about a little bit of company background of Aeon. Aeon Corporation Berhad is a part of Japan Aeon, a global retail corporation. Was founded in Malaysia in the year 1984. The company began its operations as the invitation of Malaysian governments to enhance Malaysian local retail industry. With over 178 outlets across Malaysia, Aeon provides a wide variety of products and services, ranging from everyday essentials to fashions and lifestyle goods. Its business strategy emphasizes being a comprehensive shopping hub, integrating physical stores with digital like My Aeon to Go. Aeon business models focuses on becoming a one-stop destination for customers to buy anything they want. By combining sustainability and digital transformation into its operations, Aeon has established itself as an innovative retailer that meets changing customer needs while maintaining the competitive advantage. We go to the importance of ratios in business. The first one is performance evaluations. Need to evaluating the long-term operational and financial performance to identify any strengths, weaknesses, or trends throughout the performance. It also can help to identify or compare throughout the years to know any improvement or declines from the performance. Next is decision making, which is the second point of importance of ratios in the business. Ratios plays an important part in making an accurate decisions. They provide a clear vision of the financial and operation performance. Next is risk management, where they can identify potential risks as well as can identify weaknesses in the operational effectiveness. The last one is strategic planning financial, where ratio help in identifying the goals and the way of achieving the goal.
Now, let's tap into Aeon's financial performance by comparing its statements from 2022 and 2023. This analysis will help us identify key trends, opportunities, and challenges in the company has faced over these past 2 years. Moving on to the next slide, which I will talk about liquidity ratio, which includes current and quick ratio. Based on the calculation that have been made, Aeon's current ratio showed a slight improvement in 2023, increasing from 0.50 in 2022 to 0.51. However, the ratio remains below 1, indicating insufficient current assets to cover its current liability and potential liquidity challenges. This could lead to reduced confidence from creditors and suppliers, affecting credit terms and increasing the risk of insolvency if short-term obligations are not effectively managed. To address this concern, Aeon should focus on improving its working capital management by accelerating the collection of accounts receivable and optimizing inventory levels to free up cash. They should also negotiate payment extension with creditors to reduce short-term liabilities and enhance cash flow by increasing sales of cutting unnecessary expenses. These measures will help strengthen Aeon's liquidity and overall financial position. Next, based on the calculation, Aeon's quick ratio in 2023 has slightly declined to 0.14 times from 0.17 times in 2022. This indicates that the company does not have enough liquid assets to cover its short-term obligation in either year. A ratio below 1 in both years highlights potential liquidity challenges and insufficient liquid assets to meet immediate obligation. To address these issues, Aeon should focus on improving its account receivable collection processes to boost cash flow. Additionally, renegotiating repayment terms with creditors to extend payment deadlines can help alleviate short-term financial pressures and strengthen the company's liquidity position.
Next, let's continue for the leverage ratio, which include the debt ratio and time interest ratio. Based on the calculation that have been made, the debt ratio improved from 66.7% in 2022 to 64.41% in 2023, reflecting a decrease in the company's reliance on debt to finance its assets. This is a good sign of increased financial stability in Aeon company. To maintain this pattern, Aeon should continue to reduce debt levels while leveraging equity and retained earnings for growth. Next is the time interest earn ratio. The time interest earn ratio remained the same at 2.84 times in both years, in 2022 and 2023, showing a continuous ability to repay interest payments from operating income. While this is enough, it leaves little room for problems. To strengthen its position, Aeon must focus on increasing operating income while reducing interest payments by avoiding new high-cost debts.
Moving on to asset management or efficiency ratio. Based on the calculation, Aeon's inventory ratio in 2023 has increased to 7.13 times from 6.84 times in 2022, indicating that the company is selling and replacing its inventory more frequently. This improvement reflects enhanced operational efficiency and stronger sales. In both years, the ratio highlights the company's efficiency in managing inventory. Next, based on the calculations, Aeon's average collection period in 2023 slightly decreased to 8 days from 7 days in 2022, but still demonstrating the company's strong capability to collect debts efficiently. In both years, the quick collection of payments from customers supports strong cash flow and minimize credit risk. To maintain this performance, Aeon should uphold efficient credit policy by implementing effective payment terms for customers. Investing in automated collection system can streamline invoicing and follow-up processes. Additionally, regularly assessing customer payment behavior will help manage potential risks and ensure sustained financial stability. Last but not least, based on the calculation, Aeon's total asset turnover in 2023 increased slightly to 0.79 times from 0.76 times in 2022, indicating that for every RM1 invested in total asset, the company generated 79 cents in sales. This reflects a minor improvement in operational efficiency. However, both years show moderate efficiency, highlighting the need for further optimization to maximize the revenue potential of total assets.
For the next slide, we will be talking about the profitability ratio. The key for this ratio include net profit margin, operating profit margin, return on assets, and return on equity. Based on this slide, we can see that the operating profit margin declined from 7.88% in 2022 to 7.25% in 2023, suggesting higher operating costs or weaker pricing power. To improve, Aeon company should optimize cost, enhance efficiency, and explore pricing strategies to boost revenue. Next, the net profit margin, which reflects overall profitability, improved slightly from 2.69% in 2022 to 2.78% in 2023. This increase shows better cost management and efficiency. To continue this progress, Aeon should focus on boosting revenue and controlling operational costs. We can also see the return on assets, which measures how efficiently the company uses assets to generate profit, increased from 2.05% in 2022 to 2.20% in 2023. This improvement indicates better asset management and higher profitability. To further improve, Aeon should optimize asset utilization and invest in productive resources. And last but not least, the return on equity, which shows how well the company generates profits for shareholders, increased slightly from 6.16% in 2022 to 6.18% in 2023. This reflects consistent performance and effective use of equity. To enhance returns, the company should focus on increasing net income and leveraging equity strategically.
Now, let's move on to the industry comparison, where we evaluate Aeon's financial performance against the industry average for 2023. This analysis will help us to understand how Aeon stands in the competitive retail market and highlights areas of strength and potential improvements. First, we will look at the current ratio, which measures a company's ability to cover its short-term liabilities with short-term assets. Aeon's current ratio is 0.51 times, significantly lower than the industry average of 1.58 times. This shows that for every RM1 in current liabilities, Aeon is only supported by 51 cents in current assets, compared to the industry average with RM1.58. This indicates that Aeon may face challenges in meeting its short-term obligations. The low ratio shows insufficient liquidity, which could lead to financial stress during periods of fluctuating cash flow. Next, we have quick ratio, which excludes inventory to focus on liquid assets like cash and receivables. Aeon's quick ratio is 0.13 times, far below the industry average of 1.0 times. This highlights Aeon's heavy reliance on inventory to meet its liabilities. A low quick ratio could be risky, especially in unexpected downturns or during slow-moving inventory cycles. Retail companies usually maintain a lower quick ratio due to high inventory levels. However, Aeon's ratio is drastically low, which shows that there may be some problem of management of receivable, cash and liabilities in compared to its competitors. Now, let's discuss the inventory turnover ratio, which measures how efficiently a company manage and sell its inventory. Aeon's inventory turnover is 7.13 times, slightly above the inventory average of 7.1 times. This indicates that Aeon is managing its inventory efficiently, turning over stock at a competitive rate compared to peers. This strong performance reduces holding costs and risk of inventory obsolescence, showcasing Aeon's effective inventory management practices. Moving on to the debt ratio, which shows the proportion of assets financed through debt. Aeon's debt ratio is 64.41%, lower than industry average of 75.3%. This is a positive indicator of finance stability, as Aeon relies less on debt financing compared to its competitors, which reduces its exposure to interest rate risk and financial pressure. Additionally, this lower reliance on debt may also give Aeon more flexibility to secure favorable financing terms for future projects or expansions, enhancing its long-term sustainability. Next is the profit margin, which reflects profitability as a percentage of revenue. Aeon's net profit margin is 2.78%, significantly below industry average of 6.16%. This indicates inefficiency in converting sales into profits. This lower profitability could be due to higher operational costs, lower sales efficiency, or pricing strategies. Addressing these areas is crucial for Aeon to improve its bottom lines. Moreover, Aeon might be prioritizing long-term growth over short-term profits, which can explain the lower margins. While this approach can yield future benefits, it is essential to balance it between current profitability to satisfy shareholders. Finally, we have the return on equity (ROE), which measures how effectively a company generates profit from shareholders' equity. Aeon's ROE is 6.18%, slightly higher than the industry average of 5.25%. This indicates that Aeon is performing well in creating value for its shareholders, showcasing its ability to utilize equity efficiently to generate returns even with low profit margin, as seen from the external environment. Overall, Aeon performs better than the industry average in terms of its inventory turnover ratio, debt ratio, and return on equity, reflecting efficient inventory management, financial stability, and strong shareholder returns. However, it lacks in liquidity ratios and net profit margin, which highlights challenges in liquidity management and profitability.
The third task, which is recommendations. The first part, which is strengths of Aeon Berhad. The first one is strong management and profitability. Aeon has high ability in generating their profits from common equity. Aeon shows that they has slightly improvement from the year 2022 to 2023. Next is good asset management and operational efficiency. This shows how effectively can the company generate profit using their asset. This efficiency shows that the company can generate more profits using fewer assets. Next is strong market presence. Aeon in Malaysia is something well known. They have strong presence across Malaysia, where they has wide network of retail such as hypermarket, supermarket, and the retail sector. Their existence in Malaysia guarantees that the company can maintain its position in Malaysia for such a long time. The next part, which is weaknesses of Aeon. The first one is high percentage of debt ratio. Aeon has high percentage of debt ratio, where they need to require more debts to finance the asset. Aeon needs to allocate significant portion of resources to manage their debt. Next weaknesses, which is low liquidity. Both of the year 2022 and 2023 shows that Aeon has below the requirement of 1, showing the lack of liquidity to meet the short-term obligations. Next is intense competition in the retail sector. There are lots of competitors such as Mydin, Lotus, and Giant that will fight with Aeon to be the main dominance in the retail sector. They often offer affordable goods that will put pressure on Aeon to maintain its product qualities as well as customer satisfaction. Next is action to improve the shareholder value and company. The first point, which is reduce debt ratio. They can increase their revenue through increasing in the sales as well as new income streams. Next is increase liquidity. The way is need to increase the current assets, particularly on the cash or asset that easily turn into cash. The higher the value of the current assets, the higher the value of the current asset. Next is optimize asset utilization. They need to improve the use of resources. Also, they need to know the best way to efficiently use resources to get effective return. Next is strengthen the financial performance, which they need to increase their profitability through increase of revenue and decrease their expenses. They need to boost their revenue through entering new market or expand their products. The last one, which is the conclusions. The summary of overall Aeon's performance. There are mix of strengths and weaknesses in the financial performance. In the positive side, there are benefits from the brand recognition and the large market existence. For the negative side, where there are the liquidity issues as well as high debt ratios, indicate that they are depends on the credit. For the future of the company, it shows that Aeon has potential growth of its digital presence from e-commerce. They need to modify its product and services to give more enjoyable and memorable shopping experience. They aim to strengthen the existing customer relationship as well as gaining more customer in the future.
That's all from us. Thank you.